Vivek Rajpal, India fixed income strategist at Nomura India, joins in on the show, and within minutes from now we'll have another expert as well join in. Vivek, hi, morning. You know, the currency has been one of the best performing Asian currencies in the last 1 month. While we have seen steady equity flows to India and oil prices have also remained below $70 to a barrel, what according to you has led to the recent rupee appreciation?
So I think to start with, India had some risk premium built in for geopolitical tensions. And as soon as that event got behind us, we saw inflows coming into the equity markets. So that's one of the reasons. Indeed, Reserve Bank of India surprised positively by cutting rates, and that was another factor which helped. Also, I think one of the most talked factors from India perspective was the election uncertainty. But as soon as geopolitical tension got over, I think election uncertainty related risk premium also came down, which also led to the appreciation. These were the local factors which helped. As far as the global factors are concerned, we are generally seeing easier financial conditions because of the Fed dovishness, and it's really a Goldilocks kind of a scenario for India, because on one hand we are seeing a dovish Fed, dovish ECB, while on the other crude oil prices are much more stable. So I think a lot of positive local and global factors contributed to this rally in INR.
So Deep, hi there, good morning. We recently had the news that the RBI has proposed the new norms for the foreign portfolio investors to attract long-term FPI investments into debt markets. This is, you know, the guidelines for the VRR or the voluntary retention route. How much do you think that has helped?
So I think obviously that has helped in the sense that it gives some stability to the FPIs, and from that perspective. But along with that, there's also the recent measure that the RBI has introduced in terms of the FX swap, which also affects the hedging cost and makes the VRR route all the more lucrative for the FPIs. So yes, it is one of in terms of one of the factors which is helping the rupee in terms of flows. But I don't think it is entirely the VRR, but it's, I think, the other domestic and local factors as of now. The VRR will come into play, I think, a little later. Not the recent move cannot be attributed fully to the VRR, but more to the domestic and other the external factors which are clearly at play.
Right. Vivek, so what would you say? I mean, does it seem like the gains on the rupee are sustainable given the RBI's recent move on infusing rupee liquidity via forex swaps?
So, I mean, rupee has done pretty well over the last month or so. And we have reached a level where I think it's more of a neutralish zone. Rupee should consolidate around current levels. What RBI has done in terms of introducing FX swap to infuse rupee liquidity into the system is an interesting measure. It actually brings down the FX hedging cost. It also improves the carry trade as far as Indian debt markets is concerned. So yes, this should be seen in a positive light. But having said that, over the last 1 month, various factors have played in terms of resulting in rupee appreciation, as I pointed out earlier. And now we have reached a level where probably we should see a consolidation. Let's not forget that we are heading into a season where election-related headlines will become equally important. So I would say I'm neutralish at these levels on rupee.
Enough. Suvadeep, what exactly do you think is the rationale of the Reserve Bank to inject the rupee liquidity through long-term USD INR sell swap auction? Do you think that the aim of the RBI is to stem the recent appreciation that we've seen in the currency?
I don't think it's right to really attribute that the recent appreciation and link it to why the RBI, or link it to RBI's rationale in terms of any kind of levels of the USD INR. But I think what it kind of signals is that there is some amount of fatigue within the RBI also in terms of how much of OMO purchases have been done. And the need for alternate routes in terms of injecting liquidity. Obviously, it helps that flows are coming in, not just in equities, very recently in the debt side also, which kind of correlates or kind of mixes in with the RBI's objective of injecting liquidity. But at the same time, I think it is also to offset a lot of the OMO purchase that has been happening and find alternative routes towards which the FX route is something that has come up as the option. It has not been used earlier, but it's not something altogether new in the the global monetary policy or liquidity policy management. It has been done by a few other EMs, and I think RBI is it has to look at other routes other than the typical OMO and all, which tends to bring in a bit of a fatigue and yield curve distortion, etc.
Right. Shubhadeep, the RBI has so far used considerable amount of OMOs, which we just discussed. But beyond that, what is your own view on foreign equity and debt flows to India and how they are likely to impact the currency moves?
See, the equity flows have been there for quite some time, and the debt flows have picked up recently. Most recently, as in if I look at the first half of March, I think the debt flows have become positive, which was not the case earlier. But I think more than that, it's kind of a bit of a comfort in terms of how the elections are probably going to pan out, and that's what is playing on the FII's mind. So from a foreign investor perspective, there are a couple of things which are probably going through their mind in terms of allocation to India. First of all, the election-related issue in terms of whether the incumbent government comes back to power and what kind of numbers it may garner. I think they are kind of the market is kind of settling in at a comfortable outcome. So I think that is a positive that the FIIs are picking up. Secondly, in terms of the external sector, there are few risks that have receded. One of them is obviously the crude price risk, which has been one of the biggest movers in terms of affecting the INR movement. And secondly, in terms of the developed markets monetary policy, that also has become favorable for any kind of risk on flows. To that extent, there has been an easing in the global financial conditions, and we have seen flows into other emerging markets also. And now the flow is kind of catching up in terms of flows to India. So I think all these factors taken together is what is driving the INR strength of in the current phase.
Right. Just to get in your perspective then, Vivek, the experts believe that the RBI's move on the forex swap will help to further show the forex reserves. What is your view?
Absolutely, I think so. Let me also give some thoughts on why I think RBI did this move. I think it helps in terms of bringing in flows for sure. It also helps in terms of policy transmission. what we were seeing was that a repo rate cut, which RBI did, was not really getting transmitted into, for example, corporate bond yields. Though RBI was infusing liquidity through open market operations, it was helping only the GSEC curve, and that too only the front end of the GSEC curve, whereas the market interest rates were generally higher. What this facility does is it not only infuses liquidity, but it also helps the carry trade, and in a way it helps the whole structure of interest rates. So it helps on policy transmission. And yes, I think we have to see first of all whether these low FX hedging costs sustain or not, and that will largely depend on how the auction on 26th of March goes. But I wouldn't be surprised if we continue to see use of this liquidity management tool, and if lower FX hedging costs sustain, we will likely see more inflows in the debt markets.
Vivek, a quick take as to what exactly you're, making of the movement in the bond market. The yields on the 10-year government bond, they barely budged post that brief rally we saw after the February rate cut. What do you think the expectation is from the Reserve Bank and outlook on bond yields?
Is also suffering from the fact that now that we have a new liquidity management tool, there will be less open market operations indeed, and what this tool is helping is the front end of the curve, but not the longer end of the curve. In terms of repo rate, we expect another cut in the month of April. I think though the first reaction of what RBI did has been primarily concentrated in the front end of the curve, but I wouldn't be surprised. If soon we should see transmission of lower yields in the front end into back end as well, and then 10-year yields start rallying. I think we are a little bit away from that scenario because market needs to see how the bond supply in April and May goes, and then there's election uncertainty. Nevertheless, sometime in April or May we should peak, and then bond yields should move lower from a medium-term perspective in India.
Vivek, Shubhadeep, both of you, thank you so much for taking the time out and really highlighting what's going on with the currency and whether or not this strength is looking sustainable. Good speaking with both of you.